Hello my fellow investors and welcome back to another viewer requested fundamental analysis video. Guys, let us spin the wheel to see what kind of company we should analyze today that you all recommended for the month of July. So let's see what company we analyze today. And we got the company BAM. Now, why does it feel like I have done this company before in the past? Nonetheless, though, this was brought up by none other than, it was brought up by Stefan Lawway. I don't know if you're still watching, Stefan, but if you are, well, congratulations, your company got chosen. So let's take a look at this company's fundamentals. Let's take a look at maybe if they had a recent earnings. We could take a quick look at them, and of course that will be linked in the description below if I did. And then let's see for the current share price, this is looking like a buy. So with that said, let's get started with this analysis. So here we have the company, guys, Brookfield. Now, the first thing that I want to take a look at is, of course, what they actually do, their company profile. First thing though, before of anything, guys, this is a Canadian company, so anybody who wants more Canadian companies, well, add this one to the list, right? And the second thing is that this is an asset management and custody banks, meaning that even though for financials we would normally use book value per share, right? However, because it's asset management and custody banks, we can actually use discounted free cash flow. Now, let's take a look at what they actually do for a little bit. We got Brookfield Asset Management provides alternative asset management services. Its renewable power and transition businesses include the ownership, operation, and development of hydroelectric, wind, solar, and energy transition power generating assets. That's actually kind of cool, I'm not gonna lie. The company's infrastructure business engages in the ownership, operating, and development of utilities, transport, midstream, data, and sustainable resource assets. So it's actually really interesting. They're an asset management, but they hold a lot of like niche kind of, I guess, developing technologies, right? So that's really interesting to see. Now let's take a look at their earnings summary because they just had it on August 9th. We got EPS normalized actual coming in line at 32 cents. EPS gap actual missed by 3 cents, coming in at 28 cents. And the revenue of $985 million, which is missed by $111.22 million. So because this was recent, I would actually like to take a look at a quick glance at their earnings. And of course, like always, this will be linked in the description below for everybody to read for yourselves. So let's take a look at this, guys. We got here the CEO's comment. Actually, sorry, before even that, $37 billion of capital raised year to date, on track to achieve record inflows of close to $150 billion in 2023, close record $27 billion for infrastructure fund to date, and committed to new investments of $50 billion year to date. All right, now let's take a look at what the CEO actually had to say. Quote, we delivered strong results in the second quarter, showcasing the resilience of our business and stability of our fee streams that are driven by nearly 85% of fee-bearing capital attributable to long-term perpetual funding source. Year to date, we committed to investments worth $50 billion. The scale, stability, and diversity of our businesses continue to differentiate our franchise with clients and counterparties. He added, we also continue to see very strong momentum on the fundraising side. We've made terrific progress so far this year, having raised $37 billion of capital to date, and expect this to accelerate in the second half of the year as we progress our efforts on recently launched funds. With these fundraising efforts combined with approximately $50 billion in additional insurance inflows, we expect to raise close to $150 billion of capital this year, which should drive meaningful earnings growth in 2024 and beyond. All right. So here we have the operating highlights. Let's take a look at this really quick. We got over here, we have raised $74 billion over the last 12 months, with $17 billion raised during the second quarter and $37 billion raised year to date. Notable fundraising updates since the beginning of the second quarter include: we closed $3.4 billion in capital of our fifth flagship infrastructure fund. Our third infrastructure debt fund has raised $4.3 billion to date, surpassing our previous fund size of $2.7 billion. And we held significant first close for Oaktree's 12th flagship opportunistic credit fund for $3 billion. So they continue on to say a bunch of other things. However, I'm going to leave for you guys to read that for yourselves. I do want to take a look at one more thing, and that is the regular dividend declaration and establishment of dividend reinvestment program. The board of directors of Brookfield Asset Management declared a quarterly dividend of 32 cents per share payable on September 29, 2023 to shareholders of record as of close of business August 31st. So unfortunately, the ex-dividend date already passed. Nonetheless, though, it's interesting that they do pay out a dividend. I'm really curious to see how this is in relationship to the free cash flow. So here we have the calculator. We got the ticker for BAM, market cap of $14.4 billion, a small PE of 7.81 with a current share price of almost $35. So taking a look here at the graph, we can see that on the 1 year, this isn't showing us anything. And well, the reason for this is because this company, I believe, just IPO'd as of December 1st. Yeah, look at that, as of December 1st, 2022. So this is a pretty brand new company here in the market. Interesting. Now, year to date, we do have this. This is up a whopping 23%. 52-week range is $26.76 to $36.50. Now, as we just read, they do pay out a dividend, and annually per share, this is around 96 cents, which is a yield of 2.74%, no payout ratio, no 5-year CAGR, and no dividend growth because, I mean, well, they literally just IPO'd December of last year, so that's not surprising. Ex-dividend date, as we saw, was August 30th. Payout date will be on September 29th, and they pay their dividends quarterly. Based on the current shares outstanding and this 96 cents in annual dividends, they pay out $376 million in dividends every single year. However, as of their 5-year average free cash flow, they're left with a negative $127 million, which is a problem. And as of their last year's free cash flow, it is negative 2.75. Now, this was understandable because, well, okay, I'm actually going to show you guys in just 1 second that we really can't take a look at anything in regards to the 5-year scale because they literally just IPO'd last December. So yeah, the numbers are a little bit funky. Nonetheless, though, the last year's free cash flow, you can see that it is very, very bad. And well, last year's payout ratio, it is negative 15.87%. So let's take a look at this. Now, as I just said, guys, they don't have 5 years worth of data. In fact, Seeking Alpha only goes back 4 years. So this 1 year ago value, it's actually this year's trailing 12 months. Just FYI. So this is already very, very difficult to do because of the fact that we don't have 5 years of data. Nonetheless, though, on net income, we got 5 years ago, well, technically 4 years ago, of almost $2 billion, $1.9 billion, to today of 1.13. That is a decrease of 41%. But again, this year isn't over yet. You can see that this little small dip right here occurred 4 years ago, but that's actually because of COVID. As we can see right here, that December 2020, well, yeah, they went from 1.9 down to 398. So yeah, it was a COVID related thing, not really an issue. All in all, though, I'm gonna have to give this one, guys, a 50% because I really don't know where this is going. I really don't. Now, looking at the free cash flow, again, we don't have 5 years of data. However, this is kind of looking bad here. We got 5 years ago of $828 million to 1 year ago, well, technically trailing 12 months, negative $2.4 billion. That is a massive decrease of 386% with an average of $249 million. Again, we don't have enough data. However, this is a big problem. All in all, I'm gonna have to give this thing maybe like a, oh man, I was gonna give it like a 20%, but I'm gonna give it like a 10% because this is a massive decrease. Looking now into the revenue, this one's actually doing somewhat good. 5 years ago of 2.17 billion to 1 year ago of 2.13 billion. That's a decrease of almost 2%. But again, this 1 year ago value is the trailing 12 months. So yeah, they dipped a little bit here during COVID. Then they did fairly well, but then they came back down. I'm gonna say, guys, I would think like a 40% when it comes to the revenue. Now, when it comes to the assets minus liabilities, now here's the thing, guys. 5 and 4 years ago, we didn't have this data. So I just extrapolated the 3 year ago to the 5 and 4, which is why they're exactly the same. So here we can see that from 3 to today, that is quite a hump, right? Increase then decrease and a massive drop again. Average assets, it is $17.6 billion. Average liabilities is $7.18 billion. Doing this, we get $10.4 billion. I'm gonna have to give this, guys, it's decreasing, right? We can pretty much ignore the 5 and 4. I'm gonna have to give this thing maybe like a 10%. Yeah, I would say like a 10% or so. Cash flow minus the liabilities. Again, we don't have the 5 and 4 years when it comes to the liabilities. So we can see here that this is kind of all over the place. 3 to 2 years ago, that's a massive drop going further into negative. But then as of 1 year ago, technically the trailing 12 months, yeah, that's a big jump, guys, right? From negative 11.63 billion to negative 5 billion. And again, the average, it is negative 8.85 billion. I'm actually going to give this thing a 50%. I have no idea where this is going in the future. Shares outstanding is actually really easy to figure out because they just came out last year in December, and they came out with 396.2 million shares. And as of today, they've actually bought back a little bit, going down to 391.7. But yeah, there really isn't anything for me to look at here. I'm going to have to say a 50%. And lastly, when it comes into cash and equivalents, they currently hold $12 million with an average of $2 billion. The overall grade is pretty much, I don't know, it's literally nowhere because no matter what I give it, we don't have enough data. This company just IPO'd just a few months ago. So yeah, with a net income of 50, free cash flow 10, revenue 40, assets minus liabilities 10, cash flow minus liabilities 50, and shares outstanding of 50, overall grade of 34. I don't know where this thing is going. But let's take a look at what price we should pay for this company. So coming over here to the discounted free cash flow. Well, right off the bat, we could see that not adjusting for debt, guys, we got $59.41, and then adjusting for debt, pretty much the same, $59.16. Current share price of $35. So right here, it's already looking like a great buy. However, if we take a look at Seeking Alpha, we can see that the forwards estimate at negative 58.6. So I am not sure, right? I'm not going to put negative 58.6 because I don't think that that's real. I'm sorry, I just don't. So I'm actually gonna leave this as a blank because it's such a brand new company. I don't have enough data to put any of these numbers in. You know, I just don't know. Now, what we can do though is we can take a look at the sector median and be a little bit conservative when it comes to this. In fact, I just changed my mind. Let's do this right now. And seeing that the sector median is 5.41, I'm going to say for the revenue, right? I'm going to say for the revenue, let's say negative, sorry, not negative. Let's say 2, then let's say 3, and then let's say 4%, right? Let's do that. And then for the projected share buyback, let's just do a negative 1, 0, and 1% because I really have no idea where this is going. And with this, we can see $63 to $69 from the lowest to the high assumption, not adjusting for debt. And then $62.91 to $68.87, 5, 10, and 15% margin of safety. We got $53.48 to $65.42. It's looking like a good buy, but again, there's a lot of uncertainties when it comes to this company, seeing that we don't have enough data to extrapolate as to what we can look at in the future. So do that information as you will, guys. Again, not financial advice. Every investment is the present value of all future cash flow. Please use these calculators. They are available for free, as well as the earnings support, which will be linked in the description below. I went over it, but it was like skimming it. I'm trying to keep these videos under 15 minutes. So yeah, again, I can't really go over all the earnings reports when, you know, I'm trying to keep this under a certain time frame. Nonetheless, though, I highly encourage everybody to read it for yourselves because, again, you know, this is not financial advice. So all we ask for in return is just like, subscribe, comment. It really does help her with the algorithm on YouTube as well as Rumble. Now, when looking at this dividend, putting in $5,725, even though the yield is slightly above 2.5, putting in that money, guys, we get $157 in annual dividends per share. And when looking at the options change, we can see that for September 15th, which is next Friday, there's no bids for the puts and only one bid for the call side at $35 for a strike of 35. Looking at the October 20th one, we have a little bit more, though. For a strike of 30, we got only one bid on the put side for $10, and for a strike of 35, we got two bids, $115 for a strike of 35 for the call side and $5 for a strike of 40. All in all, though, thank you so much, Stefan, for this recommendation. I don't know if you're still watching. It's been quite a while since I've done, you know, the viewer recommended. But again, we have just started this. So if anybody wants any recommendations, I'm going to have to put all of you guys that recommended in September in a separate pile, just so that way it's a little bit more fair. I'll finish the July one, then go into September, assuming that I can get through that before the next earnings season. So anyways, when it comes to Brookfield, we just need a lot more data. That's really it. But again, do your own research for yourselves and see if you would like to invest into this company. That pretty much does it for this one, everybody. Y'all can follow us on the new tech sites. Link is in the description below. So with that said, peace out, and we will see you all next time.